Yesterday, we saw this SoFi CEO, Anthony Noto, actually present at the JP Morgan Tech Conference that was actually hosted by Reggie Smith. Funnily enough, Data Driven Investing actually points out, why were they talking at a tech conference and not a bank conference? Kind of funny. Now, there wasn't actually a whole lot of information that was presented on this call, and it was starting to be a little bit boring halfway through until the end. Then he started to pull out claims that we hadn't heard before. And this is what I want to cover because the first claim that I'm going to jump into right away is probably the most mind blowing. And that was that there are 500 million accounts in the United States. We've announced in our quarter that we're over 11 million members. I really want to get that to 50 million members over the next 5 years. And then adding to that, my hope is that our product per member at that point is on average at 3, which means, we have heavily loyal customers that have 5 or 6, and then some other ones that have 1 or 2. Now, to help visualize this 5x in members over the next 5 years, not only have I included these screenshots here, we're actually going to be going through the exact spreadsheet that I created for this, as well as showing off the products, the amount of revenue, and the profits that were expected for this. But if you guys are in the Future Investing Discord, you guys can actually get this spreadsheet and play around with it, but we'll get to that in a second. The products also are expected to 10x, as the products per member right now are at 1.5 times, so he's expecting a double on that, while also 5xing members. But lastly, whenever we go back here, he said that there's 500 million accounts in the United States. Now, the population is not 500 million, it's about 350 million, but he talks about 500 million accounts. But if you actually think about it, that's technically a product, but then he associates that with the amount of members that he's actually going to get. Roughly, though, what he's saying in this account is that roughly they want to capture about 10% of the total audience within the next 5 years. But really what he's saying is that they want to capture about 15%. That's unless they actually are thinking about other markets as well. And he does actually say this in this call. There's an opportunity for us to expand internationally, which we haven't talked about, but there are some really unique markets that I think are interesting based on what we've seen in the credit card business and lending business. And so international expansion is also a potential area for us to go into. Now, the exact area that I think he's talking about is Latin America. They've seen a massive expansion for their credit card businesses and lending businesses through companies like Mercado Libre and Nubank. And so potentially he's also looking to get into areas like Mexico, Colombia, Brazil, all of these different areas that could lead to expansion like crazy just based on the total amount of population there. That would have an impact on revenue per user as well, but let's jump over to my spreadsheet and I'll show you guys how I'm breaking that down. All right, so in this spreadsheet, what you're going to see is that in this dark blue, we have what we already know. Okay, these numbers are certain. We've seen Q1 numbers already. And then in this teal is all assumptions. Now, also in these red circled rows here, what you're going to see is my assumptions. Now, it's pretty steady at 7.52% because this actually leads us to be at the very end in 2030 at 50 million members, just at a 7.52% growth rate. Okay. Now in Q1, we did actually pass 800,000 accounts. However, this is including their churned accounts as well. So the total amount has to get to 50 million, not just 50 million minus some people that churned off because either they've just completely inactive, switched off SoFi, or passed away or something like this. Anyway, they're expecting to keep up with this high 7.5% growth rates, which means that we hit over 1 million new ads by Q1 of 2026 almost immediately. Okay, holding up nearly a 34% ad year over year on members consistently. If we start to go out, which I do actually think there will be a time where we could potentially add 2+ million new members on really good quarters. Okay, I can see that happening. Near the end, whenever we're starting to add 3.5 million new members per quarter, I mean, worldwide, some of the fastest growing fintechs of all time do not do this consistently. That would be extremely aggressive. It, in my opinion, would have to include international expansion, but overall, this is what I'm seeing for members. Now, if we take a look at products as well, and we just scroll this down a bit, what we can end up seeing is that, and we can also include products per member there, with a steadily increasing products per member, which is what my assumption was, you can see that we're already by Q3 of 2027 adding 5 million new products within SoFi. If we get near the end where we hit 150 million products or 3 products per member, what we end up seeing is adding 14 million new products quarter over quarter while adding 3.5 million users. So This is very aggressive in terms of the growth rates here. And you can see it's a little bit fluctuating differently quarter over quarter, but overall, still unbelievably high growth. Products in Q2 of 2026 growing by 61% or 62%. That seems extremely aggressive. Very hard for me to believe that that's possible. And by the way, I'm also being very conservative because I'm bringing it all the way out to Q2. That's not exactly what he said. He said we had 11 million members. I'm assuming that he was talking from Q2 because that's where we actually are. These growth rates would actually be faster than what we saw in Q1, meaning that revenue, or not only is members going to hold up well, but it's actually going to be faster into the future than what we've seen previously. For any business, that's an extremely hard target to keep up with. Now, for revenue per member, if we just scroll this down even more, what we can end up seeing is that revenue per member continuing to increase, but not because I'm assuming their revenue per member. I'm assuming revenue per product continues to fall over time, whether that's from the shift of lending products going more towards financial services, or definitely more close to the end where you're starting to see potentially international customers coming on that just simply do not make as much or do not have as many assets as US customers would. So that would really dramatically lower the revenue per product. Now, with this spreadsheet, if you guys do join the Discord, you'll be able to adjust these numbers as you want, and then you'll see which numbers are my formulas and then which ones you guys are able to just simply adjust. But revenue overall is looking to be growing anywhere between 30% to 20% near the end. Now, he did say he wants to hold up about a 20% growth rate. I've got 10% near the end and 30s and potentially even 40% at the highest here year over year. So it sort of balances out to that 20-ish percent overall. And then lastly, we have total contribution profit, where all I was adjusting was the margin. And this was assuming an increasingly better margin over time as their operating leverage continues to scale with the amount of members that they end up seeing. And I could actually end up seeing this much higher than 61.5%. We'll talk about that in a bit. But overall, I'm seeing that this continues to grow and gets to roughly about $1.5 to $1.6 billion a quarter of profit by Q2 of 2030. Now, that might be a little less depending on the amount of different products or services that they get into. If capital markets start expanding faster than potential new products are, there's so many different areas that this could completely change. And that's why long-term targets like this usually are not very accurate. But just going off of Anthony Noto's targets, this is sort of how we could look at it. Now, the reason I said that contribution margin could get even better than 61% in the long term is the fact that they even said that credit cards and Invest is still losing about $100 million a year. Okay. If you just assume that they were not losing 100 million, not even adding anything to financial services contribution margin would go from 49% to 57% just by adding in 25 million a quarter. Okay. If then they were to actually bring on 25 million, not lose 25 million, but bring on 25 million, then we would already see 60 plus immediately. That's without any additional efficiencies in the loan platform business, SoFi Money, or even starting to monetize Relay. Now, let's talk about his comments about the tech platform, because honestly, they were much more bullish than what I was expecting. First, he said, I'm happy to say that in the last 6 to 8 months, they have been very robust in terms of total demand generation. We've announced another deal that we cannot name the name of, which I'm excited about. Now, he did actually allude that this was another consumer brand similar to Wyndham Hotels. It'll be very hard to find this deal, but potentially looking through terms and conditions, we might be able to find something over the next couple months. And then this, by far, was the most bullish comments that he made. A couple of deals that we lost 4 years ago, where people decided to prioritize cost over functionality, those partners are coming back to us. There's 2 deals in particular that we're about to close on that are pretty significant, that are highly visible, that we already have installed bases on, where the partner optimized for price, not for the level of sophistication that we have, not the innovation that we provide, and now they're coming back to us. Now, if I'm not wrong, I think I know the exact 2 companies that he's talking about because they left similarly in this area. They're highly visible and they have large install bases. That would be Current and most definitely Vero. Vero did actually leave right around 4 years ago. I think Current, I think left around 4 years ago, 2021-ish. Vero left in 2020. And he also talked about them leaving before they owned Galileo. And I actually spoke with Anthony Noto a while ago, and he brought up the fact that this was actually what happened whenever Vero left. It was actually due to the fact that they were looking for a new core provider like Technisys, and they didn't know that they were going to have a system like that. So now that they do, it actually looks like they might be coming back. Now, overall, 2025 is not looking super great for Galileo, but yet there are 10 deals that will produce revenue in the first quarter of 2026 that produced no revenue in the first quarter of 2025. It's been a long time since that's happened. Now, we know for a fact that that's happened back in 2020 and 2021, whenever the fintech, sort of boom was happening due to COVID. Everyone was going towards digital banking, and there was so many opportunities for new companies. Now, those new companies could try to create a new system, or they could simply partner with a company that already had those payment APIs already set up. They could just immediately get started. So we saw a bunch of deals, but they weren't really high or large size or large installed bases. It's seemingly that these 10 deals might actually be much larger than the deals that they used to close whenever they were getting a bunch of deals in a single year. But lastly, let's talk about valuation really quickly. As he said, someone asked the question about 55 to 80 cents in 2026 and why such a big range. You could imagine that the 80 cents being a scenario where our growth slows more than we would like, and it's going into beyond 2026, and it's probably in the low 20% ranges or maybe even high teens. Well, that's an environment where we're going to drive a lot more profitability. Because obviously, if you can't drive growth, then that means you have a lot of extra savings, right? You're not spending a ton on sales and marketing or other efforts like that. So you actually have a lot more to put towards the bottom line. At the other hand, he said, at the 55-cent range, we see that as a higher growth environment where we're growing in the 20 plus percentages. And it's pretty stable, and the investment justifies to keep investing in the future to grow, to have a longer revenue growth and therefore longer earnings potential. Now, in my opinion, and maybe this is the wrong way of looking at it, this seems like a little bit of a cop-out. I would assume that you would try to potentially end up doing both. For a company that has been able to execute every single quarter and beat on all of their earnings predictions, it kind of seems like you're already trying to justify ending in the lower range of this EPS to say, hey guys, by the way, this is also meaning that we're going to grow significantly fast. I hope to see them succeed on both of those ranges. High 20 plus, 30 plus % growth rates, yet also achieve on EPS as well, because you're actually just executing in every area. That's not going to happen if the tech platform or one other area of their business is underperforming, but potentially if they can execute in all areas, that can be the case. Let me know what you guys think down in the comments down below. But until next time, bye for now.